Every single stock out there has a story, a whole life cycle, really, from the day it's born on the public market to all the drama that happens day to day. So today, we're going to demystify that entire journey. We're going to break down the key moments in a stock's life and turn all that complex market noise into a simple, powerful story. All right, let's get into it. Here's our game plan. We've got 4 essential chapters. First, we're cracking the IPO code. Then we'll learn to read the price's zigzag, the actual language of the market. After that, we'll dive into the 4 phases every stock goes through, and we'll wrap up by looking at the market's built-in safety brakes. And that brings us right to Chapter 1, the IPO, the initial public offering. This is it. This is the moment a private company steps out onto the public stage for the very first time, and its stock is officially born. So here's the million-dollar question, right? Is an IPO a golden ticket, a chance for quick profits, or is it just a huge gamble? Well, the truth is, it can be both. And the key to telling the difference, it all comes down to doing your homework before that stock even starts trading. Think of this document, the DRHP, as the official user manual for a new stock. Seriously, it's the company laying everything out on the table, their business, their financials, and, importantly, all the potential risks. Now, a few years ago, you'd need a team of experts to get through one of these, but that has totally changed. Today, it's actually incredibly simple. You just download the DRHP, upload that file to an AI tool, and you can literally just start asking it questions. You can ask for a quick summary for potential listing gains, or you can dig deep and ask about the long-term fundamentals of the business. It puts some seriously powerful analysis right at your fingertips. Now, before a stock officially lists, you're going to hear this term thrown around a lot. GMP, or Gray Market Premium. Here's what's fascinating. This price has almost nothing to do with how good the company is. It's a pure measure of market hype and demand. It's all about how many people are trying to get a piece of the action, often just based on brand recognition. It can give you a feel for the initial buzz, but it is definitely not a guarantee. And this just shows you exactly what I mean. Take KSH International. The IPO price was set at $384. The GMP, the hype, suggested it might dip just a tiny bit to $382. But look what actually happened when the market opened. The real price was down around $370. It's a perfect example that hype is one thing, but the market always gets the final say. Okay, so the stock is listed, it's out in the wild. But what do all those price movements actually mean? How do we start to read the story the market is telling us every single day? Well, that brings us to our next chapter, reading the price's zigzag. This is such a core idea from what's called Dow theory, which is basically the foundation of modern market analysis. A stock's price almost never ever moves in a perfect straight line. Instead, it's this series of zigzags. And understanding the pattern of those zigzags, that's the absolute key to figuring out where the market is headed. And those zigzags really only form 2 main patterns. In an uptrend, the price makes a new peak, we call that a higher high, and then it pulls back, but to a level that's still above its last low point, a higher low. It's literally like climbing a set of stairs. On the flip side, a downtrend is the exact opposite. It's like walking downstairs, a series of lower highs and lower lows. In both cases, the average price is clearly, without a doubt, moving in one direction. And of course, there's a third option, this sideways trend. This is when the price is just bouncing around between a ceiling and a floor, making basically equal highs and equal lows. It's just stuck in a holding pattern, not really making any progress. But here's the thing. These trends don't just happen out of nowhere. They're all part of a much bigger story, a cycle that has 4 very distinct phases. And honestly, the best way to picture this is to think of it like a road trip. So, the journey kicks off with accumulation. This is where the big institutional investors are quietly packing the car, buying up shares at low prices. Then you get the rally. That's the main drive when the price really starts moving up. Along the way, you might get a consolidation phase, which is kind of like a quick rest stop. And finally, you reach the destination, distribution, where those same big players start to sell off their shares. Accumulation and distribution are perfect mirror images of each other. During accumulation, which happens after a stock has already fallen a lot, the smart money, we're talking big funds, is buying quietly from the public, trying not to alert anyone. Distribution is the exact opposite. After a massive rally, when prices are high, they start quietly selling those shares back to the public, trying not to cause a panic. Okay, so this is absolutely crucial, telling the difference between consolidation and distribution. On a chart, they can look pretty similar. They're both just sideways pauses, but the context is everything. Consolidation is a temporary break during the road trip. After a short pause, the rally usually continues. Distribution, that's the end of the trip. After that, the car turns around and the trend reverses. Now, to keep this whole market road trip from turning into absolute chaos, the exchanges have built-in safety rules. You can think of them as speed limits for stocks, designed to tap the brakes during really extreme moves. We call these circuit limits. These limits basically set a maximum daily price range for a stock. You'll typically see them at 2, 5, 10, or even 20%. If a stock's price smashes into that limit, either up or down, trading gets paused for a bit. So what happens when a stock hits its circuit? Well, an upper circuit means it's a buying frenzy. There are only buyers and nobody is willing to sell at that price, so trading locks. A lower circuit is the reverse, a stampede of sellers with absolutely no buyers in sight. In either case, normal trading just freezes to let things cool off. Now, this is super useful information to have, right? Knowing a stock's daily speed limit can help you understand its potential range for the day. So, where do you actually find this stuff? It's usually incredibly easy. In most trading apps, you can just pick a stock, open up what's called the market depth view, and boom, you'll see the exact price levels for the upper and lower circuits for that day. It's a simple check that can make you a much more informed investor. All right, so let's recap our whole journey. We've seen that an IPO is really just the first page of a much longer story. We learned that trends are the market's language, written in those critical zigzag patterns. The 4 market phases, accumulation, rally, consolidation, and distribution, they reveal the actual plot of the story. And finally, circuit limits are the essential rules of the road that keep everything in order. When you understand this life cycle, you're not just looking at random squiggles on a screen anymore. You're actually equipped to see the narrative, the structure, and the forces at play behind the price. So the next time you look at a stock chart, just ask yourself, what chapter of its story am I looking at right now?